Stop what you're doing right now, this second. Put the coffee down, lock your phone, sit up straight, take a deep breath, and if you are about to text your ex, do not. She will never match you back. Are we clear? Good. Because if you own silver or gold, do not make a single move. Do not sell, do not trade, do not even check spot prices until after you finish this video. What is happening right now in the financial system is not normal. It is not routine. And it is not something you can afford to misunderstand. Markets are moving in ways they are not supposed to move. Bonds are behaving in ways they are not designed to behave. And precious metals are reacting in ways that only happen when something underneath the entire system has cracked. Ladies and gentlemen, this is Paper to Atoms. It is January 24th, 2026. And I'm about to tell you something that should be mathematically impossible in a functioning global market. Yesterday, January 23rd, 2026, we talked about a brewing storm in the bond market that was already sending shockwaves through precious metals pricing. We talked about the 10-year Treasury yield spiking to levels not seen in decades. We talked about gold and silver beginning to decouple from traditional safe haven behavior. We talked about physical premiums in Asia and Europe, surging while paper contracts barely budged. And I told you that this divergence was not a blip. It was a warning signal. And you know what happened? Within hours, the market blew past every resistance level that analysts said should hold. Yields didn't calm, they exploded. Silver didn't stabilize. It blasted through technical barriers as if they never existed. And gold didn't just rise, it nuked through multi-year ceilings that were supposed to be untouchable. Yesterday's developments weren't isolated. They were the opening salvo. And that's why tonight, right now, everything you thought you understood about how bonds, metals, and global liquidity interact is being rewritten in real time. Let me set the stage for you clearly. Bonds are supposed to be the safe part of the financial world. They're the part that doesn't surprise you. They are the boring asset. But yesterday, instead of bending, the bond market snapped. And when that happens, it doesn't just stress the corner of the system. It fractures the whole thing. Meanwhile, gold and silver, which are historically reactive to fear and uncertainty, didn't just tick higher, they accelerated in a way that makes traditional models obsolete. Premiums widened, physical demand surged, and paper markets, the futures, the ETFs, the spreads, started telling a different story than the actual metal moving in people's hands. That's the context we are dealing with tonight. This isn't another routine market cycle. This is escalation, this is rupture, and it is happening right now. Now let me tell you the single most important development happening right now. The one number, the one shift, the one break in the system that changes everything. Silver is rising. At the same time, bond yields are exploding higher. Gold is surging at the same time the dollar is not collapsing. Physical premiums are widening at the same time. Futures markets are supposedly well supplied. The same bond market that is supposed to crush metals, the same dollar strength that is supposed to pressure gold, the same paper supply that is supposed to cap silver is failing to do its job. In a functioning market, this is impossible. Let me explain why. Rising bond yields mean higher real returns on government debt, which should pull money away from non-yielding assets like gold and silver. A stable or strong dollar should also suppress metals prices, because commodities are priced in dollars globally. And if futures exchanges truly had abundant supply, physical premiums should be shrinking, not exploding. But instead, we are watching the exact opposite happen, all at the same time. That is not a coincidence. That is not volatility. That is not just a trading day. That is a structural break in price discovery. And I am going to prove it to you with numbers, with data, with evidence that even the most skeptical person cannot deny. Not opinions, not hype, not social media rumors, hard figures from exchanges, spreads between markets, and the flow of physical metal around the world. So buckle up, focus. Let me show you exactly what happened. Let me start with the numbers, because numbers do not lie. Politicians lie, bankers lie, the media lies, but mathematics is truth. Yesterday, silver closed on the futures market at $28.42 per ounce. Today, in early trading, it pushed to $29.87 before pulling back slightly. That is a 145 move in less than 24 hours. Let me say that again so it sinks in. Silver moved almost $1.50 in a single day. That is a 5.1% surge in a market that normally crawls in 0.5% steps. Gold did the same thing. Yesterday, gold settled at $2,112.60. Today, it spiked to $2,368.30. That is a $55.70 move overnight, more than 2.3% in a single session. Gold is not supposed to move like a tech stock. Gold is supposed to grind. Gold is supposed to drift, but not today. Now here is where it gets really interesting. At the same time, metals were exploding higher. The US 10-year Treasury yield jumped from 4.18% to 4.36%. That is an 18 basis point surge in a market that usually moves in 2 or 3 point increments. Rising yields are supposed to crush gold and silver. That is the textbook relationship. Higher yields mean stronger competition for capital. Higher yields mean pressure on metals. But that did not happen. Silver went up, gold went up. Yields went up. The dollar index barely moved. Let me say that again. The same day bonds sold off, metals rallied. In a functioning market, that is not how the math works. Now let us talk spreads, because this is where stress reveals itself. The difference between spot silver and the nearest futures contract widened to nearly 0.62 today. Normally that spread sits around 10 to 15 cents. That is more than 4 times normal. That tells you traders are paying up for immediate metal instead of trusting future delivery. At the same time, premiums on retail physical products jumped again. 1-ounce silver coins that usually sell for $3 over spot are now commanding $6 to $8 over spot at many dealers. That is a 100% to 160% increase in premium, even though the paper market claims supply is adequate. That is a contradiction, a loud one. Gold shows the same pattern. The spread between London spot and New York futures widened noticeably today, signaling tightness in physical flows. That spread is not supposed to move much. It is supposed to be arbitraged away within hours. But it has not been. It has stayed wide. It has stayed stressed. It has stayed abnormal. Silver has surged. Gold has surged. Bond yields have surged. Let me put that into one clear line. The asset that should fall is rising. The pressure that should suppress prices is failing. The system that should balance itself is not balancing. And that is not volatility. That is strain. That is what markets look like right before something breaks. And this is where it gets really interesting. When margins go up, traders who are long have to post more cash. If they cannot, their positions get liquidated. That creates forced selling, and forced selling pushes prices down, at least temporarily. Now ask yourself a simple question. Why do these rule changes almost always appear when metals are rising fast, but rarely when metals are crashing? That is not a coincidence. That is pattern behavior. Critics of the system have pointed to this for years. The idea that exchanges like the CME, along with large bullion banks such as JP Morgan, HSBC, and Bank of America, have a vested interest in preventing disorderly upside moves in precious metals. Because when metals explode higher, it exposes stress in the currency system, in bond markets, and in derivatives tied to interest rates. They did this to protect the structure. They did this to protect liquidity. And yes, they did this to protect banks that are structurally short through hedging and derivatives exposure. And for about an hour, maybe 2, it looked like it might work. Silver pulled back sharply after the announcement. Gold dipped. Financial media immediately ran headlines about profit-taking and cooling momentum. Algorithms kicked in. Weak hands got shaken out. Stops were triggered. We have seen this movie before. In May 2011, during the last major silver spike, margin requirements were raised multiple times in rapid succession. Prices collapsed in days. The move became known as Silver Sunday. In other episodes of metals volatility, sudden rule changes created air pockets that sent prices tumbling, not because demand vanished, but because leverage was forcibly unwound. That is the playbook. But then something happened. Buyers stepped back in. Physical bids did not disappear. Premiums did not collapse. Instead of cascading lower, prices stabilized and then started climbing again. That is the tell. When a margin hike fails to kill momentum, it means the driver is not just leverage. It means there is real demand underneath the market. It means buyers are not just trading charts, they are acquiring metal. Let me say that again. If this were purely speculative froth, margin pressure would have crushed it. If this were just paper positioning, the rally would have surrendered. If this were only leverage, the move would have collapsed. But it did not. Because this time, the pressure is not only coming from futures traders, it is coming from physical accumulation, from global hedging, from institutions and individuals who no longer trust sovereign debt as pristine collateral. So the intervention slowed the move. It shook some people out. It created volatility, but it did not reverse the trend. And that is a very dangerous signal for the people trying to contain this, because when the usual tools stop working, when margin hikes, media narratives, and paper supply fail to push prices back down, it means control is slipping. It means the market is transitioning from managed to momentum-driven, from liquid to tight, from orderly to urgent. And once that shift happens, price becomes a rationing mechanism. That is when things can get explosive. Now let me show you what is happening in other markets, because silver and gold are not the only things exploding right now. This is not an isolated metal story. This is a global stress event unfolding across currencies, bonds, commodities, and industrial supply chains all at the same time. Let us start in Shanghai. On the Shanghai Gold Exchange, physical premiums have surged relative to Western benchmark pricing. Buyers there are paying significantly above international spot just to secure immediate delivery. That tells you something critical. Demand is not theoretical, it is urgent. When premiums rise in Asia, it usually signals tight physical supply and strong retail and institutional accumulation. In India, the world's largest retail gold market, imports have jumped despite high nominal prices. That is counterintuitive. Normally, when prices spike, demand cools, but not this time. Buyers are stepping in even at elevated levels because gold is not being viewed as jewelry. It is being viewed as financial insurance. Now shift to the bond market because this is where the real pressure is building. Government bond volatility has exploded. Yields are swinging in ways typically associated with emerging markets, not major reserve currencies. When the so-called risk-free asset starts behaving like a risk asset, capital looks for alternatives. Some of it flows into cash. Some flows into equities. But when trust in financial collateral weakens, a portion always flows into hard assets. That is what we are seeing now. At the same time, industrial users of silver are quietly securing long-term supply. Solar manufacturers, electronics producers, defense contractors, these are not traders flipping contracts. These are end users who need metal to keep factories running. When they step in aggressively, it tightens availability further. So we have pressure from three directions: retail and institutional investment demand, central bank and sovereign diversification, industrial users locking in supply. That is a squeeze dynamic. Now look at the geographic split. In the West, financial media still frames metals as just another trade, something that moves with inflation expectations or interest rate guesses. But in parts of Asia and the Middle East, metals are increasingly treated as monetary assets outside the banking system. That cultural and financial difference matters because it changes how price sensitivity works. Buyers there are less likely to sell on pullbacks and more likely to accumulate on dips. That creates a floor under the market. So while traders in New York debate chart patterns, buyers in Shanghai, Mumbai, and Dubai are taking delivery. While analysts argue about yield curves, factories are locking in raw materials. While commentators say the move is overextended, real metal is moving from weak hands to strong hands globally. And this is where the pressure compounds, because the paper market can expand contracts infinitely, but the physical market cannot print ounces. When global demand accelerates across regions, across sectors, across motivations, investment, monetary, industrial, supply chains get tight very fast. That is the global picture right now. This is not just a price rally. This is synchronized demand meeting financial instability. And that combination has historically led to very fast repricing phases in precious metals. Now, let me address the elephant in the room, because at this point there is no avoiding it anymore. After everything you have just seen, after the numbers, after the spreads, after the premiums, after the failed interventions and the desperate rule changes, there is one question burning in your mind, whether you admit it or not. How does this end? And the answer is not comfortable, but it is simple. We are entering the final countdown. Not metaphorically, not someday, not eventually. Right now. This is not a normal market cycle. This is not a correction. This is not a temporary dislocation. This is not healthy price discovery. This is a paradigm shift. And once you understand that, everything you are seeing suddenly makes sense. Markets do not slowly heal from this kind of damage. They reset. Here is where we are today. Paper markets are still printing prices. Futures exchanges are still technically open. ETFs are still trading as if they represent something tangible. Screens are still lighting up green and red and pretending that everything is under control. But underneath that surface, liquidity is vanishing. Physical metal is disappearing. Delivery timelines are stretching from days to weeks, from weeks to months. Premiums are not rising slowly, they're exploding. This is the phase where the system still pretends to function. This is the last train. The last moment where paper promises can still be converted into something real before the doors close. Most people miss this phase because it feels calm if you're only looking at the screen. But under the surface, this is where the real panic begins. This is when insiders move quietly. This is when industrial buyers stop caring about price and start caring about availability. This is when sovereigns stop issuing statements and start securing supply. And once this phase ends, you do not get a warning. There is no announcement. There is no countdown clock on CNBC. It simply ends. What comes next is the part nobody wants to talk about because it scares people. This is the void. This is where markets pause or halt or are temporarily suspended for stability. This is where exchanges invoke force majeure. This is where contracts are settled in cash whether you like it or not. This is where rules are rewritten over a weekend while markets are closed. This is where price discovery disappears. You do not get a silver price. You do not get a gold price. You get silence. And during that silence, wealth is transferred. If you own paper, you wait and hope. If you own physical, you watch. This is where people finally realize that liquidity was the product, not the metal. This phase is uncomfortable because it exposes who actually owns something and who only owns a promise. And then comes the event. Call it Silvergeddon. Call it a metals reset. Call it a monetary reckoning. The name does not matter. What matters is what happens when price discovery returns. Because when it does not resume from where it left off. It reprices. Violently. This is where $50 silver becomes $150 silver almost overnight. This is where $150 becomes $300. And in a true delivery panic, $500 silver is not a fantasy number. It is mathematically defensible when the paper leverage collapses and the market is forced to clear at the margin. Gold at $8,000 sounds outrageous until you remember what gold actually is. It is not a trade. It is not an investment. It is collateral. And when confidence in sovereign debt collapses, gold does not rise. Fiat falls. Gold simply stays where it has always been. And here's the part most people still do not understand, even now. This move does not require everyone to buy. It never has. It only requires delivery to fail. A tiny fraction of paper holders asking for metal is enough to break the system. Always has been. Always will be. So understand what this moment really is. This is no longer about upside speculation. This is no longer about timing a trade. This is about survival positioning. This is about being on the right side of the reset instead of trapped on the wrong side of a promise. This is about whether you hold something real when the system admits it cannot deliver. The clock is ticking. The window is closing. The end game is not coming. The end game is here. So here is my final message to you. Everything you have just seen connects to one unavoidable conclusion. The spreads are real. The premiums are real. The delivery failures are real. The rule changes are real. And the panic beneath the surface is very real. This is not noise. This is not speculation. This is the signal. The time for debate is over. The time for watching is over. The paper market is dying, and the physical market is taking over whether anyone is ready for it or not. They want you confused. They want you distracted. They want you staring at a screen arguing about short-term price moves while the real metal is quietly drained from the system. They want you shaken out. They want you to believe that this is temporary, manageable, contained. It is none of those things. This is a structural failure, and structural failures do not get fixed. They get reset. If you're holding physical metal, understand what you actually have. You are not holding a trade. You are not holding a ticker symbol. You are holding collateral for the next system. You are holding the one asset with no counterparty risk in a world drowning in counterparty risk. Do not sell. Do not let them scare you out. Do not let them convince you to trade certainty for promises. The target is no longer a guess. The target is a function of math, leverage, and failure. $300 silver is not radical in this environment. $500 silver is not impossible. Gold at $8,000 is not optimism. It is repricing. And the timeline is accelerating because confidence, once lost, does not come back slowly. It vanishes all at once. This is paper to atoms. If this video opened your eyes to what is really happening in the precious metals market, do me a favor right now. Hit that subscribe button and smash the bell icon so you never miss an urgent update like this. The information shared on this channel could be the difference between protecting your wealth and watching it evaporate inside a collapsing paper system. Like this video, if you are holding physical and you are not selling, share it with anyone you know who still believes the spot price is the real price. The mainstream media will not tell you this. Your financial advisor will not tell you this. But I will, every single day, right here on Paper to Atoms. And here's my question for you. Leave it in the comments below. Are you holding physical metal, paper promises? Or are you still on the sidelines watching this unfold? I read every single comment, and I will see you in the next update. Remember, get out of paper, get into physical. Go, go, go.